Hi everyone, welcome back to the channel. This video is a part of the monthly portfolio update series made for the individuals invested with me on eToro. During August, the portfolio was up 10.32%, and for the year, we're up 41.15%. We are invested in KWeb, Alibaba, Cooper Standard, Warner Brothers Discovery, VF Corp, GXO, Baidu, Crocs, Estee Lauder, and JD. The first company we will cover in this update is GXO Logistics, the world's largest pure-play contract logistics provider. But before we get into the quarterly performance, I wanted to explain what contract logistics is. In simple terms, it's when a company like GXO is hired by major retailers, manufacturers, or tech firms to design, run, and optimize their supply chain operations. GXO manages their warehouses to fulfillment centers. Think of GXO as a behind the scenes logistics engine that gets your online orders packed, shipped, and delivered. But here's what makes GXO different. The company has an asset light model. That means it doesn't own all the buildings and equipment. Instead, it leases and operates the facilities and focuses on technology, efficiency, and customer service. This model is less capital intensive, allows for faster scalability, and generates higher returns on invested capital, something that we will notice as we go through the quarterly results. Let's start with some top-line numbers in the executive summary. GXO reported 3.3 billion in revenue, up 16% year over year, the highest in 9 quarters. They've also won 307 million in new business, up 13% from last year, and they've raised full year guidance for adjusted EBITDA. This indicates a strong momentum in their core business. Of the 307 million in new business, 51% came from new customer activity, companies expanding their operations. 23% came from outsourcing, businesses moving their in-house logistics to GXO. 26% were won from competitors. That 23% from outsourcing is a huge deal. This means that more companies are realizing that they cannot run logistics as efficiently as specialists like GXO. This is a structural, long-term trend adding to the investment case for GXO. GXO is built on 4 powerful secular drivers: automation, e-commerce, outsourcing, supply chain complexity. These aren't cyclical, they're here to stay. And GXO is positioned as a technology leader in logistics. With GXO, we're invested in a company that is not competing in AI and robotics, but we have a company that uses this technology to its advantage. They invest heavily in robotics and AI-driven warehouse systems and digital platforms. This allows them to offer faster, more efficient, and scalable solutions than traditional logistics providers. We can see it in their operating return on invested capital, stated at 46%, up last year, and above their long-term target of 30%. This is a direct result of their asset-light model. They're generating huge returns without being weighed down by heavy real estate investments. But one of the most compelling reasons to invest in GXO is the leadership behind the scenes. Brad Jacobs, the executive chairman. Brad Jacobs is the founder of GXO and the former CEO of XPO Logistics, which he built from a small trucking company into a global logistics powerhouse. His entire career has been defined by a disciplined M&A strategy, buying companies at attractive valuations, integrating them efficiently, and driving strong returns on capital. At XPO, he didn't just grow the company, he transformed it through a series of smart, value-creative acquisitions. And it's the exact same playbook that's being run at GXO. The most recent Wincanton acquisition is a deal that expands GXO's footprint in the UK and into high-margin sectors like aerospace, defense, and industrial logistics. Along with mergers and acquisitions, the management has made some excellent capital allocation decisions. GXO repurchased 2.6 million shares this quarter. When a company buys back its own stock at prices below the intrinsic value, it is one of the most effective ways to create shareholder value. It increases earnings per share, reduces the share count, and signals confidence from management. With respect to our portfolio, GXO is an 8% position on a cost basis and 5% on a value basis. This discrepancy is because our other positions have done well relative to GXO's stock. I do not plan on changing this allocation in the foreseeable future. Next up, I'll briefly explain what I think is happening with Warner Brothers Discovery. So recently, the stock has gone up by 50%. And the reason is that Paramount Skydance is preparing a bid for Warner Brothers Discovery. According to this report, this offer is a majority cash bid backed by the Ellison family, and it's intended for the entire company, although there is no formal offer submitted yet. I have a feeling that Paramount Skydance is trying to front run the competition by making their bid right now. Warner Bros. Discovery is on a path to separate the company into two independent public companies by mid 2026. The first company will be Warner Brothers. This will be the high growth, IP driven powerhouse with assets like HBO Max, Warner Brothers Pictures, DC Studios, and the entire film and TV library. The second company will be Discovery Global. This will be the cash flowing, brand driven network business with assets such as CNN, TNT, the Discovery Channel, Food Network, Animal Planet, and so on. The interesting part of this separation is that according to the 10Q, if the separation happens, Discovery Global may choose to retain up to 20% stake in the spun off company, which would be the Warner Brothers entity. Discovery management is going to use that stake to deleverage the balance sheet in a tax efficient manner. Essentially, they could sell down that stake later to pay off the debt. The re-rated multiple for both companies would be reflected in the stock price, benefiting shareholders. I think that Paramount Skydance is trying to front run the competition and buy out the entire company before the split goes through. Of course, we'll get more clarity on the situation once a concrete deal comes through. Right now, it's all just speculation in the media that is driving the stock price. For our portfolio, Warner Bros. Discovery is an 8.52% position on a cost basis and over 10% on a value basis. I'm not adding or selling down our position. We are going to watch this unfold. I would be very surprised if there are no competing bids, but even if the company just goes ahead with the split to unlock the value, that's fine too. Finally, you may have noticed that we are no longer invested in Occidental. I sold the position to replace it with Baidu and JD. We may get back into Occidental later, but I see more upside for companies in China tech space in the near term. With that, I hope you have a better idea about some of the companies in our portfolio. Please share any questions that you might have in the comments. You'll also find links to my social media pages in the description below if you want to contact me directly. That's all from me. Thanks for watching this update. Take care.